AI hyperscalers are reporting enormous profits, but one accounting assumption is making those profits bigger than they otherwise would be. One well-known investor estimates that America's biggest cloud companies could be understating a single cost by $176 billion over the next 3 years. Back in episode 1, we mapped over $700 billion in planned 2026 AI infrastructure spending. That money already left the building. The real question is how it shows up on the income statement afterward. When a company buys a GPU, it doesn't expense the full cost in year 1. It spreads that cost over the chip's assumed useful life, and that single assumption changes how big or small profits look every year after. Take a simplified example, a $40,000 GPU. Depreciated over 3 years, that's about $13,300 a year in expense. Stretch it to 6 years and the annual expense drops to about $6,700. Same chip, same cash spent, very different profit. Company filings show the assumptions moving in one direction for years. Alphabet extended servers from 4 years to 6 in 2023. Microsoft made the same 4 to 6 year move that year. Oracle stretched its estimate twice, first to 5 years, then to 6. Meta extended the useful life of most of its servers and network assets to 5.5 years starting in 2025. In its own filings, the company said the change reduced that year's depreciation expense by about $2.9 billion. Amazon went the other way. In 2025, it shortened the useful life of some servers from 6 years back to 5, citing the faster pace of AI hardware development. That added about $1.4 billion to its depreciation expense. Same AI infrastructure boom, same year. Meta extended the useful life of most of its servers and network assets. Amazon shortened the life of some of its equipment. Useful life isn't just a physical property of hardware. It's also a management estimate about how that equipment gets used. Here's the tension underneath. NVIDIA is pushing toward a roughly annual cadence for major new AI platforms, Hopper, then Blackwell, then Rubin. Meanwhile, the accounting on chips already bought assumes 4 to 6 years of useful life. Burry's argument is simple. If NVIDIA ships a meaningfully better chip almost every year, why are hyperscalers still booking 4 to 6 years of useful life on the ones they already bought? By his estimate, if that gap gets corrected, Oracle's 2028 earnings could be overstated by roughly 27% and Meta's by roughly 21%. These are Burry's estimates, not company guidance or audited figures. Burry has repeatedly framed this as a speculative infrastructure build-out, not a one-company accounting scandal, drawing comparisons to past cycles where real demand eventually caught up to capacity, but only after steep losses along the way. NVIDIA pushed back directly. In a memo to Wall Street analysts, it argued that longer depreciation schedules are supported by the actual real-world longevity and utilization of deployed GPUs. And the strongest counterexample just arrived. In August 2026, CoreWeave disclosed it signed an A100 contract running into 2029 at what its CFO called an attractive price. The A100 debuted in 2020. That means a GPU generation nearly 9 years old could still be generating contracted revenue. Burry's broader counterargument is that physical survival and economic competitiveness aren't the same thing. A chip that still works isn't automatically a chip still earning what it once did on the highest value workloads. Whoever turns out to be right, longer useful lives have one clear accounting effect. They reduce near-term depreciation expense and raise near-term reported earnings. That matters to hyperscaler margins and potentially to how investors value the entire AI build-out. Here's the bridge worth remembering. A shorter useful life doesn't create new spending. The cash already went out the door in CapEx. It just forces that same cash to hit the income statement faster and profits look smaller sooner. This resolves one of 2 ways. If older GPUs lose economic value faster than companies expect, useful life estimates may eventually get shortened or assets written down. If older hardware keeps finding profitable workloads for years, today's longer schedules may prove reasonable. 3 questions worth tracking. Will more companies follow Amazon and shorten their assumptions, or follow Meta and extend them further? If a correction comes, which company absorbs it first? And is the market pricing AI on the cash that's spent, or on an estimate that can still change? The chips are already shipped, the CapEx is already spent. The unresolved question is how long those assets keep generating economic value, because that determines how quickly the cost should hit earnings. Next episode, we go inside the one factory process almost every AI chip depends on, and what happens if it can't keep up.